All right, everyone. Get ready for a deep dive today. We're going deep into some really unique equities. And then, oh boy, the crazy world of corporate actions. The stuff that companies do that could really shake up your portfolio.
Yeah, it's like we're giving you the secret cheat codes
Yeah.
to unlock some serious SIE exam knowledge. And hey, maybe you can even use this to impress your friends with some fancy finance talk.
Exactly. It's kind of surprising, but did you know that? Buying stock in a foreign company is actually easier than you think. And sometimes companies actually want their stock price to go down. Don't worry, we're going to break it all down.
We're going to make this stuff make sense, I promise, using real-world examples that you can actually relate to.
And to help us navigate this financial jungle, we have the amazing Catherine with us. She's our expert at taking these complex financial concepts and turning them into something that won't put you to sleep.
Huh, thanks. I'm ready to jump in.
Okay, let's start with this. Have you ever thought about investing in companies from all over the world? I've always been fascinated by global markets, but just the thought of dealing with foreign exchanges and all that, it just makes my head spin.
Oh yeah, I get it. It can seem really intimidating at first, but that's where these things called American Depository Receipts come in. ADRs, for short, they're like your VIP pass to the global stock market.
A VIP pass. Okay, now I'm really intrigued.
So let's say you want to buy stock in, let's say a Japanese company, like Nintendo, right?
Yeah, that's a good one.
Okay, so you could try to figure out all the international trading stuff yourself, but honestly, who has time for that?
Not me. I'd rather just be playing Mario Kart.
Exactly. So instead, what happens is a U.S. bank will buy a bunch of Nintendo shares on the Japanese exchange, okay? Then they issue these receipts, the ADRs, that represent those shares. You buy the ADR on a U.S. exchange in U.S. dollars, and boom, you're a Nintendo shareholder.
So it's like I can own a piece of Nintendo without ever leaving my couch. Okay, I like that.
Yeah. Exactly. And the best part is the bank handles all the complicated stuff, like converting dividends, dealing with taxes, all of it.
That's incredible, really. But there's got to be some kind of catch, right? Nothing in life is ever that easy.
Well, you do still have to think about currency risk. Like if the U.S. dollar gets stronger compared to the Japanese yen, your ADR could lose value, even if Nintendo is doing well.
Ah, the joys of global economics. So what about political risk, though? Like, what if the Japanese government suddenly decides that they don't like foreign investors anymore?
Yeah, that's definitely a valid concern. Things like political instability or policy changes in a foreign country can for sure impact ADR values. It's always a good idea to do some research on the political situation before you invest.
Makes sense. So ADRs are like this shortcut to global investing, as long as you're aware of the risks, right? What else should our listeners know about ADRs, especially for the exam?
Okay, so one thing that trips people up is that ADR holders usually don't get voting rights. But honestly, most individual investors don't vote anyway, even for U.S. stocks.
Yeah, that's a good point. Okay, let's shift gears now. Let's go from the global stage to something a bit more secretive. I'm talking about Rule 144 stock. It sounds like something out of a spy movie, right?
It kind of does, yeah. Basically, Rule 144 tells you how you can sell certain types of stock, like restricted stock and control stock.
All right, break it down for us. What exactly is restricted stock?
Okay, so think of it as getting in on the ground floor of a company before it even goes public. So let's say your friend is starting a cool new tech company, and they give you a chance to buy shares before they IPO. That's restricted stock.
So you get in early, maybe at a lower price. Sounds like a pretty sweet deal.
Right.
What's the restriction then?
Usually you have to hold on to that stock for at least 6 months before you can sell it. It's kind of like a waiting period to make sure everything is legit, and it prevents people from just flipping shares too quickly.
Ah, okay, so that's the catch, like a mandatory cooling off period.
Exactly.
Now, what about control stock?
All right, so control stock is stock that's owned by people who have a lot of influence in the company, like CEOs, board members, or major shareholders. The bigwigs.
Right, the people with all the inside information.
Exactly. So there are rules about when and how much they can sell to prevent insider trading.
That makes sense. So what are the rules for them? Do they also have to hold it for 6 months?
Control stock has its own separate rules. So if, let's say, a CEO wants to sell some of their shares, they have to file this form called Form 144, and that form determines how much they can sell within a 90-day period.
So it's not like they can just sell everything at once?
Nope. There are limits in place. It's to prevent them from dumping a ton of stock and making the price plummet.
Yeah, that would not be good. So how do they actually calculate those limits then?
It's based on two things. It's either 1% of the company's outstanding shares or the average weekly trading volume of the stock over the
Yeah.
past 4 weeks. And they can sell whichever amount is greater.
Oh, okay. So it's like they're trying to find a balance between letting insiders sell some of their shares, but also protecting regular investors from big price swings.
You got
This seems like something that could really trip people up on the exam.
Yeah, it can be tricky. The exam might give you some calculation questions about this, so make sure you really understand the formula and how to use it.
I think it would be really helpful if we could go over an example later on.
Yeah, for sure. We can do that.
All right, let's move on. We talked about secret stock rules. Now let's talk about, I don't know, golden tickets maybe?
Hmm.
Next up are rights and warrants. I'm getting some serious Willy Wonka vibes here.
Ha! I see it. They do sound a bit magical, you're right. Both of them give you the right to buy stock at a set price. But there are some important differences between them. Think of them like, I don't know, coupons for future stock purchases.
Okay, I like that. I'm grabbing my shopping cart. Tell me more about these stock coupons. Let's start with rights. What are they all about?
All right, so stock rights. Sometimes they're called preemptive rights, but basically they're like a loyalty reward for shareholders. So let's say you own stock in a company, and they're getting ready to issue more shares. They'll offer you rights that let you buy enough new stock to keep your ownership percentage the same.
Oh, so it's like a way to protect yourself
Mm.
from having your ownership diluted. That's pretty cool, actually.
Exactly. They're basically saying, hey, thanks for being a loyal shareholder. We want you to stay with us as we grow.
That's nice of them.
But one thing to keep in mind, these rights don't last forever. They're usually only good for a few weeks, so you gotta act fast. You can either use your right to buy more shares at that set price, or you can sell the rights on the market. Or, you can just let them expire.
It's like a limited time offer with options. Buy now, trade it, or toss it. Okay, now what about warrants? How are those different?
Warrants are more like long-term stock options. You'll often get them as a bonus when you buy bonds. It's like a little sweet incentive. Companies use them to make their bonds more appealing to investors.
Ah, so it's like a buy one, get one free deal, but for finance.
Yeah.
But what's the catch with warrants? There's always a catch, right?
Well, with warrants, the price that you lock in, it might actually be higher than the market price. When the warrant is first issued.
Wait, so I might be paying more for the stock than it's worth right now? That doesn't sound like a good deal.
Okay, but here's the thing. Warrants have a much longer time frame, sometimes years, even decades. The hope is that the stock price will go way up, higher than the warrants price. And then you can buy it at a discount in the future. It's a bet on the company's potential, basically.
So it's like I'm planting a seed
Ah,
and hoping it grows into a giant money tree.
pretty much, yeah. It's all about potential.
Okay, I think I'm getting the hang of this. Let's do a quick recap to make sure I'm clear. So rights are short-term, right? And they're given to existing shareholders.
Right.
And they let you buy stock below the current market value.
Right.
And then warrants are long-term. They're often bundled with bonds. And they let you buy stock at a price. That might be above market value now, but hopefully below it later.
Exactly, you nailed it.
Phew, that's a relief. Okay, let's move on to something that's always a bit confusing to me. Stock splits and stock dividends. Why would a company ever want their stock price to go down? It seems a bit counterintuitive, right?
It does at first, yeah, but there are some good reasons for it.
Okay, well, let's start with stock dividends. How do they work? And why would a company choose to do this?
Okay, so imagine a company is doing really well, and they want to reward their shareholders. But instead of giving out cash dividends, they give out more shares of stock. It's like giving everyone a bigger slice of the company pie.
So more stock, less cash. But wouldn't issuing more shares dilute the value of existing shares? Wouldn't that make the price go down?
Yes, the price per share will go down, but the total value of your investment actually stays the same. It's like if you have a pizza and you slice it into more pieces, you still have the same amount of pizza, you just have smaller slices.
Ah, okay, the pizza analogy always helps. So with stock dividends, everyone gets more stock, but the overall value doesn't change. Okay, what about stock splits then? How are they different?
Stock splits are a bit more dramatic. Imagine a company's stock price has gotten really high, like let's say $500 per share. That can be kind of intimidating for smaller investors, right?
Yeah, I wouldn't want to buy just one share.
So the company might decide to do a stock split, which makes the stock more affordable and accessible for more people.
It's like taking a $100 bill and breaking it down into smaller bills. It's the same amount of money, it's just more manageable.
Exactly. So let's say a company does a 2-for-1 stock split. If you owned 100 shares at $500 each, After the split, you would have 200 shares worth $250 each. Same total value, just more shares at a lower price.
So they're making the stock more bite-sized, basically. But what about those reverse stock splits? Those always sound kind of scary.
They do sound a bit backward, don't they? So reverse splits are the opposite of regular splits. The company reduces the number of outstanding shares, which makes the price per share go up. They often do this if the stock price has fallen really low, to avoid being delisted from an exchange.
So it's like they're taking those smaller pizza slices and putting them back together to make fewer, bigger slices, so the pizza looks more appealing.
Yeah, that's a good way to think about it. The important thing to remember is reverse splits don't change the company's value, just like regular splits and stock dividends. They just change the share price and the number of shares.
Okay, I think I'm starting to understand splits and dividends better now. Is there anything else we should know about them? Anything that might be important for the exam?
One key thing is that stock splits and stock dividends are not taxable, at least not right away. You only have to pay taxes when you actually sell the shares.
Oh, so it's like that tax-deferred party in my portfolio.
Exactly.
We've covered so much already, Catherine. Global investing, ADRs, rights, warrants, stock splits, dividends. I'm feeling a lot more confident about these concepts.
Awesome, I'm glad to hear that. But we're just getting started. There's still more to explore in the world of corporate action.
I'm ready for it.
Let's dive deeper.
Okay, lead the way.
All right, so let's get into some of the big moves that companies make. We're talking mergers, acquisitions, spin-offs, buybacks, tender offers. It's like Wall Street's reality show, right?
Ooh,
Full of drama, high stakes.
you said it. And these corporate actions, they can really impact a company's stock price and its future, too. So understanding why they do these things can give you an edge, not just on the exam, but also in your real-life investing.
For sure.
Okay, so let's start with mergers and acquisitions, or as the cool kids say, M&A. I always picture like two giant companies just smashing together, like a clash of the titans. But I'm sure it's not always that dramatic.
Sometimes it's actually a friendly merger, where two companies decide to team up to create something bigger and better. It's more like a strategic partnership, really. They can pool their resources, expand their market reach, maybe even gain access to new technologies.
So it's like the Avengers assembling, each one bringing their own superpower to the table.
Yeah.
But then sometimes it's more of a hostile takeover, right?
Exactly.
Yeah.
Sometimes one company tries to acquire another, even if that company doesn't really want it. So it becomes this battle for control, both companies trying to win over shareholders and swing the deal in their favor.
Oh, so it's like a corporate soap opera then.
Pretty much.
Okay, so what about spin-offs? Why would a company want to just spin off part of their business? It's like they're willingly giving away a piece of themselves.
Spin-offs can be a bit confusing, but often it's about highlighting a part of the business that's doing really well, but maybe it's not getting enough attention as part of the larger company.
So it's like a hidden gem that needs its own spotlight.
Yeah, exactly. By spinning it off into a separate, publicly traded company, they can attract investors who are specifically interested in that area. And that can potentially unlock even more value, both for the spin-off company and the original company.
It's like giving that hidden gem a chance to really shine.
Exactly.
All right, now let's talk about buybacks. You always hear about those in the financial news. Why are companies so into buying back their own stock?
Well, buybacks are a way for companies to return value to their shareholders. And they can also potentially boost the stock price. So by buying back shares, they reduce the number of shares outstanding, which means earnings per share goes up. And the company looks more profitable.
But isn't that kind of manipulating the numbers? I mean, their actual profits haven't changed.
Yeah, that's a valid point. It's definitely something that investors look at carefully. But companies argue that buybacks can be a more efficient way to return value to shareholders than traditional dividends.
I guess it's like taking a slice out of the pizza to make the other slices bigger.
Exactly. And plus, buybacks can send a signal to the market that the company is confident in its future. When a company invests heavily in its own stock, it's like they're saying, hey, we believe in ourselves, you should too.
It's a bold move, like doubling down in a poker game.
Yeah, and often the market responds well to that, and the stock price goes up even more.
Okay, now let's talk about tender offers. Those sound a bit more aggressive, like a company making a direct play to take over another.
Tender offers are definitely more assertive, you're right. It's like a public declaration of their intentions. They're offering to buy shares directly from existing shareholders at a specific price, and usually it's a premium,
Yeah.
Higher than the current market price.
So it's like a grand romantic gesture in the business world. I want you, and I'll pay top dollar to prove it.
Exactly. And sometimes it works, you know? The shareholders are tempted by the higher price, and they sell their shares. And then the acquiring company gets a bigger stake in the target company.
But I bet it can get messy if the target company's management isn't happy about it.
Oh, yeah, for sure. Tender offers can be friendly or hostile. It depends on how the target company feels about it. If they see it as a threat, it can turn into a real battle, both companies fighting for control.
It's like a corporate thriller with all those twists and turns.
Yeah, and the outcome can have a big impact on both companies, so it's no wonder people get so excited about these tender offers.
This is fascinating, Catherine. I'm really starting to see these corporate actions differently now.
That's great to hear. But hold on, there are a few more things you need to know, especially for the SIE exam.
Okay, I'm all ears.
Let's get into it. So we've talked about all these exciting corporate actions, but now let's get into some of the less glamorous but equally important stuff like taxes and notifications. These things might not be as thrilling, but trust me, they can really impact your exam score and even your real-world investing decisions.
You're absolutely right, Catherine. No one wants a surprise tax bill, right? Or to miss out on some crucial info about their investments.
Exactly. So let's start with taxes. The good news is that some corporate actions are actually tax-free events, at least initially. Stock splits and stock dividends, for example.
Wait, really? So I can double my shares with a stock split and not owe any taxes?
Well, not exactly. You won't owe taxes right away, but your cost basis per share will adjust. So you'll only owe taxes when you actually sell those shares later on.
Oh, okay, so it's like a delayed tax situation.
Yeah, think of it as a tax-deferred party in your portfolio.
I like the sound of that. So what about mergers and acquisitions and spin-offs? Are those taxable?
It really depends on the details of the deal. If you just get stock in exchange for your old shares, it's usually considered a tax-free exchange. But if you get any cash as part of the deal, that part would be taxable.
So it's like a stock swap party, as long as no cash is involved.
Pretty much. But remember, things can get a bit tricky with these deals, so it's always best to talk to a tax expert. You know, get some personalized advice.
Yeah, better safe than sorry when it comes to taxes. Okay, so what about buybacks and tender offers?
Those usually involve cash payments, so they are considered taxable events. You'll either have a capital gain or loss, depending on the difference between what you paid for the shares and what you get in the buyback or tender offer.
That makes sense. Cash transactions usually mean taxes, right?
Right.
So it sounds like we need to keep track of our cost basis for every stock we own.
Absolutely. Keeping good records is super important, especially with all these corporate actions happening. Your share count and cost basis can change a lot.
Got it. All right, we've tackled taxes. Now, what about those notification requirements? How do we even know what's going on with our investments?
Well, the SEC requires companies to be transparent. They have to keep shareholders informed about important events, things like dividend declarations, stock splits, rights offerings, basically anything that could impact the value of their shares.
So no more secrets.
Exactly. They have to send out notifications with all the details, like the date of the action, the payment amount for dividends, the ratio for stock splits, all of that. It's to help shareholders make informed decisions.
Transparency is key. Knowledge is power, especially when it comes to money. Okay, Catherine, I think we've covered a lot of important ground here, from ADRs and Rule 144 stock to stock splits and buybacks. But before we wrap up, I want to make sure our listeners are ready for the exam. Do you have any tips for remembering all this stuff?
Absolutely. This unit is all about the details. So cheat sheets and flashcards are your best friends. Take those complex regulations and formulas and break them down into smaller, easier to digest pieces of information.
Yeah, that's a good idea. I'm a visual learner, so I like to draw diagrams. It helps me see how the different concepts connect.
That's a great strategy. Visualizing information definitely makes it easier to remember. Another tip is to relate these concepts to real-world examples. Think about companies, like Apple, Tesla, Amazon, and imagine them going through these corporate actions. It makes the material more relatable and memorable.
Like picturing Elon Musk announcing a stock split on Twitter.
Exactly. And don't forget to practice those calculations. Stock split ratios, dividend percentages, Rule 144 volume limits. The more you practice, the more confident you'll feel.
Practice makes perfect, right?
Exactly. This material can seem overwhelming at first, but it's definitely manageable. And remember, we're here to help you every step of the way.
That's right. And if you're looking for some extra support, be sure to check out our Team Alpha SI Exam Mastery Program. We have tons of study materials, practice exams, and expert guidance to help you ace that exam.
It's like having a personal trainer for your finance brain.
Exactly. We'll help you get in shape and ready to conquer those exam questions.
So what are you waiting for? Subscribe to Team Alpha SI Exam Mastery And let's do this.
All right, everyone, that wraps up our deep dive into equities and corporate actions. We've covered a ton of information today, but this is just the beginning of your SIE exam journey. Keep learning, keep practicing, and most importantly, keep that curiosity alive.
Good luck on your exam. You got this.
And until next time on the deep dive, happy investing.